Hi everyone, welcome to the 136th episode of the Timing Research Show for November 21st, 2016. Okay, my name is Dave Kammerman. I'm the creator of Timing Research, and today we will be discussing the 165th report. So if you haven't had a chance to take a look at that, just go to TimingResearch.com/reports, and you can download any past report there. I have Dave back to talk today, so I'm going to go ahead and move that over here.
Thank you, Dave Kammerman. I forgot to my headset's actually in my book bag, so hopefully too much feedback here. I'm looking to see if I have one nearby, but thanks for having me back on the show. Jim, Kenny, let's start with you. For those of us who don't know you, I know you're a friend of the show. Tell us a little bit about yourself and tell us a little bit about OptionProfessor.com.
Sure. Well, OptionProfessor.com is in the education business regarding the options area. And the main thing is 7 option learning DVDs that takes the investor through the basics, what are calls, what are puts, and then advances them into multiple strategies like covered call writing, put writing, two-sided trades like strangles, straddles, and then of course the credit trades like credit calls and credit put spread trading, and then of course give some input and opinion on trading them after the fact, and then trying to give a good idea of what the use and the risk of all the different strategies on the DVDs, so that when somebody looks at a situation, there is a menu of choices that they could employ as opposed to only 1 or 2 things that they know about. So it's a comprehensive education program on the use of options.
Okay, cool. A lot of moving parts with options. Barry, you're up next. I'm going to ask the question, and I'm just to step away just for a second and grab, see if I can change out to a headset to avoid the feedback. Barry Rosen, FortuneCast.com. For those of us who don't know you, Barry, tell us a little bit about yourself and tell us a little bit about FortuneCast.com, and I'll be right back. Thank you.
Hi, thanks. Again, I'm Barry Rosen. FortuneCast has been around since we're into our 30th year, which is kind of amazing. We kind of combine, do a lot of swing trading. We do some day trading with the S&P. Our orientation is kind of combining Elliott wave pattern analysis with, 5 proprietary cycle techniques, and to kind of filter out what's, the Elliott waves based on what kind of cycles that we're seeing. I often end up relying more on the pattern than on the cycles, but it keeps me out of trouble. We actually cover over 13 markets. Most people are interested in the S&P. We have an S&P day trading program, which kind of focuses on just trading the edges. It's mostly kind of selling the higher opening ranges in the morning between 9 and 10 o'clock in the morning for day traders, and just taking 2 or 3 points in multiple contracts. For swing traders, we like to set up 2, 3, 4 day trades, and we have an ETF timer where we kind of like to buy SSO, the 2x SPY, or go short with the SDS. So that's kind of what we do for S&P traders. Timer Digest ranked us number 2 in March for all of last year for timing the S&P. Thank you.
Okay, I think Dave's still working on his headset. So Anka, let's hear from you about.
Hi, Dave. Well, first, thank you so much for having me here again on the show today. And for those of you that don't know me, my name is Anka Metcalf, and I've been a professional independent trader focused on equities and futures, day trading and swing trading for about 13 years. Prior to becoming a professional independent trader, I do have 10 plus years in investment banking. And I'm the CEO and founder of TradeOutloud.com, which is a trading education firm that is specialized in trading that is specialized in educating individuals how to day trade and swing trade equities and futures. We also have a lot of programs built into as continuing education into our programs, such as signal service and coaching and so on and so forth. And I'm also the designer of an institutional proprietary trading system that is based on price support resistance, specific trigger times, specific price zones, chart correlation, a strict set of trading rules, and a 10-point scoring system that enables myself and enables traders to identify the trades much more easily. And the reason why I'm saying that I'm just the designer of an institutional proprietary trading system is because I did not come up with the system. It is just an institutional system that I have adapted it for the retail trader. So it comes from the institution side, adapted it for the retail trader, that you could literally trade it with, let's say, $50,000 account up to about $1.5 million account.
Okay.
That's about.
Sounds good. And Dave, are you back? Yeah, we can't hear you at all, Dave. Or I can, at least. Hey, Dave, can you hear me? We can't hear you at all. Okay, let's go on to the reports. Jim, let's start with you. What direction do you think the S&P 500 is going to move this week from the open to close? And rate what probability you think you're correct?
Well, right now we've got the markets making new highs here today. And so obviously the momentum is very, very strong to the upside, which it has been. Since we're in new high territory, it's hard to step in front of a freight train. So the momentum is quite a bit up. You would have to imagine that it will continue unless there is something happening with durable goods orders or new home sales or consumer sentiment that might put some water on this thing. But right now, the momentum is up. So I'd have to suggest that rallying this week still seems the thing to do. And just be careful, obviously, that it has some kind of an exhaustion up here and rolls over. So the previous daily low might be something to keep in mind. If they can't take out the previous daily low, then obviously the momentum is very much to the upside. The only thing that would be concerning technically would be the VIX, which is down to 1265. And when the VIX gets down to 1265, that's in a zone where option premiums have shrunk quite a bit. And that means the market has had probably a pretty good rally. And then, it's possible that something would occur that makes some type of a correction out of here. So the only danger I see right now, as we speak, is the VIX being at 1265, which is a region where it has bottomed and had a bounce out of here. And of course, that would give some indication that somewhere up here, there could be a correction, because the VIX being so low would indicate that a turn might be not too far in the offing.
Okay, and what probability do you think? Or?
Probability right now would be 50-50, because again, we are at an extended level and we are at a situation where the VIX is quite low, and there presents a certain danger to that relationship.
Okay, thank you. And Dave, are you back? Yeah, I'm still not hearing anything from you. So Barry, let's go to you. What do you think the S&P 500 will do this week, and what do you think the probability is?
Well, we see the market topping today. We had kind of a transition day. In my last update, I was looking for around 2198 on futures and 2101 on cash. I'm sorry, 2201 on cash. We could see it pop a little bit higher. I think everybody in the world is going to have trouble kind of pushing the market through 2200 this week. We look at 5 proprietary cycle indicators, and many of them start turning down starting tomorrow into the end of the month. And so our sense is that at worst, maybe the market would go up to 2211 if it were to push solidly through 2200. But we actually I think the surprise may be to just have a small correction. Now that correction may not go more than 40-50 points. 2160 key support, 2148 to 2150 was kind of a pattern we were looking at, and that's kind of a target for next week. Maybe Tuesday, Wednesday of next week. And we just think the market's just a little bit overdone here, and people will be reluctant to push it too much higher. I mean, there is a rule: you never sell a market at all-time highs, and so we do have to pay attention to that. And the moment we're looking for, if we start taking out 21, there's a ledge at 2179 to 2180 on futures. If that starts coming out today, it's probably not going to come out today. It's more likely to come out tomorrow or Wednesday. Then we would have a light short setting up, but our overall patterns are suggesting that we will continue to make new highs next year, and we are expecting whatever high comes in the next day or two will be taken out early in the month of December.
Okay.
So percentage. I'm gonna give my forecast about a 65% chance of happening. And again, I'm a little. I don't like trading a lot during Thanksgiving because the people start heading for the exits and the ranges get kind of small, and sometimes you could get congestion for 2 or 3 days in very tight ranges between 2185 and 2200 or something like that, and then at some point some bad news will come out and the market will break early next week or something like that. So not an exciting week to trade, but we do see topping action.
Okay. So you said higher and about 65%?
Actually, my percentages for the market to be topping today or the latest tomorrow and to be down, at least 40 points, if not 50 points over the next 5 or 6 trading days.
Oh, okay. All right. And Dave, are you back yet? I still can't hear anything from you. So Anka, let's go on to you.
Okay, so I think if you would have asked me this morning, okay, so if this show would have been this morning, I would have told you that my target for this week is going to be 2200 for the SPX. And right now, we just made a high, 2197.53, and I still think we're going to hit that 2200 mark. And my projection, this is where I think the market is going to top off. So pretty much it's going to probably travel, 3 to 5 points higher. But I think it's really very extended when you take a look at current support resistance levels, and it's also a psychological level. The 2200 level is also psychological. So I think that it may run into this area of 2200 and probably stay there throughout the entire week, or perhaps try to grind a little bit slower higher. Obviously we're going to tend to have slower volume on Wednesday and Friday, and I think that this is really going to I think from my trading experience for about, I would say close to 20 years, is that I think that the markets are either going to grind up because we're in a very, very strong uptrend, and what usually the markets do on low volume, they pick a clear direction and they grind, because these are only the day traders. These are a lot of retail traders that are trading with the trend, and that's going to push probably the market higher. So I like trading around holidays, and I like trading around Thanksgivings. I also like trading around Christmas, before and after the holiday as well. And that is because I pick relative strong stocks and try to go with the trend. The market's not necessarily market is not necessarily probably going to expect to do a huge amount of rally here, due to the fact that we are really topping off, and we just broke August is high today. that was, I think it was 2193. So that was the area, the August high. So the fact that it didn't get rejected from that area and it pierced through it just shows that there is still a lot of interest in the market continuing higher. Percentage wise, I think that it can run into 2200, which was my initial target, 80 to 85%. I think that's where it's going to go, and probably it's going to hover around that area. So I'm very confident that is going to reach that area and play around in that area. But needless to say, this market, the fact that it's reaching these highs makes a lot of traders very cautious, because it's like, how can you take a long position even though you have a plethora of trades that are setting up beautifully on the daily chart, on the weekly charts for swings and for core trades, but at the same time you have the market that is topping up, so it makes you a little jumpy. The market is definitely due for a pullback, and I think that probably after the holiday, maybe into next week, we're going to expect some kind of a pullback and perhaps get the market ready for December and probably for a potential Christmas rally.
And what did you say you thought the percentage was?
I think 2200, and play around in that 2200 area for 80-85%.
Okay. All right, Jim, let's go back to you. What else are you watching for it to happen this week, or
Well, the thing about this week is it's pretty dead on the news front. We have some information coming out on Wednesday on durable goods, new home sales, and consumer sentiment, but the big stuff is going to be next week. And the big stuff is going to be actually very big, because it's going to go over economic growth, showing us what the GDP and the purchasing managers index is going to be. And then really, very importantly, is to keep an eye on the consumer, because it is 2/3 of economic growth. And you're going to get a lot of information next week on him. In that, you're going to get consumer spending, you're going to get how the wages are going, you're going to get employment, and you're going to get car sales, construction spending, and a lot of stuff that people may be buying now, discounting that there'll be good news on these numbers next week. And also inflation numbers are going to be coming out. So next week is huge on the news front, and people are definitely buying in advance of that. If these reports obviously don't meet their expectations, there could be some people going to the exits. So, those are some of the things that next week is going to be very, very important as far as trying to jar the market one way or the other. So those are some of the things that I'm taking a look at right now.
And that concludes this. And that concludes the secret of trading, as I was just saying. Did everybody get that? Did y'all get that?
Welcome back, Dave.
Y'all didn't get the last 10 minutes? Oh. Well, maybe next week. Hey, great to be back. I guess if it can't go wrong, it will go wrong. I did. So where are we? We're under.
We got through the first page.
Okay.
So if you want to go ahead.
Okay, I'll just get caught up on that. I'll go quickly. As far as who I am, I'm Dave Landry, DaveLandry.com. Predict the short term when it comes to markets, but you can stick around longer term. I'm slotted as a swing trader, and my first, I have 3 books on trading, and the first 2 books actually have swing trader in the column, in the title. But I think you can stick around longer term, because that's where the money is when it comes to trading. But longer term trading, a little too risky just to flat out longer term trade. So what I like to do is take a hybrid approach to the money and position management to get into that longer term position. I also believe trading psychology is vitally important, and I do a lot of work on that. On my website, DaveLandry.com, I have courses on all this, and I have tons of free stuff too. I have like 1,700 videos that you guys can go through, and I think over 600 columns, articles, free reports, etc. So you can get started cheaply and freely, I should say, and there's a lot of information to get you up to speed on the methodology. I also have a 21-page report, which is available to anyone who's interested in that. As far as the market direction, since I am a trend follower, I'm not going to argue with a market that's at or near new highs. We are a little overbought in here, due to correct, but I'm just going to predict up as long as we can stay near the new highs. As far as I'm not strongly bullish because we are overbought, so I'll give myself a probability of 55%. And developing events, I'm a technician, so I'm not too worried about the potential news or earnings or anything like that. But as somebody pointed out earlier, I think it was Barry pointed out, we are coming into Thanksgiving week, which can be kind of thin and choppy. And as a general statement, the markets do tend to drift a little higher. So that's how I see it for now. And then, so we're on the, are we to the question of the week now for everybody? Which would be, no, we're to.
Tim gave his answer on question 3, but Barry and Anka I haven't yet.
Oh, okay. All right. Well, let's go to Barry next then. Okay, Barry, for your answer to number 1, which was market direction, what specific developing, please share what specific reasons you think the S&P 500 will be headed in the direction you choose, which I didn't catch. And then, if you want, you could share charts if that's something you could do easily. If not, next time you're on, we could show you how to do that.
Okay, thanks, Dave. Well, I spend a lot of time on pattern analysis, and I also look, I'm also kind of a commonsensical trader. And whenever you get to kind of key numbers like 2200, I mean, people are just a little wary about kind of pushing through those numbers right away. Eventually, they will go, and so and I agree with a lot of our other guests that you can get. Usually the week of Thanksgiving, the volume goes down, you get choppy action. So we could be in a tight range between 2185 and 2203 or something this week. But I think come next week, most of my cycle indicators are pointing down until the end of the month. So I'm not sure what kind of news is going to develop, but it's just it's just common sense too. When you get we've gone up 170 points since the election, there will be some profit taking coming in at these key numbers. So that's kind of where I'm focused. And I'm always kind of looking at the Elliott wave patterns. When you get these trending markets, the Elliott wave doesn't really mean anything because people are just buying the pullbacks on moving averages and stuff like that. But I'm really kind of looking at this idea that we're just too close to these very kind of key numbers. I mean, a couple of weeks ago, I was looking at extended targets up to 2217 to 2220. I wouldn't negate that those could come in, before all this happens. But anytime you get close to these key numbers, it doesn't make sense to kind of bet on a few more points to the upside. Anyway, that's all I've
Okay. Anka, what specific reasons do you think the S&P will be headed in the direction that you chose?
I think the technicals point out higher, and the fact that we're making these higher highs almost every single day, and we just broke above the. I can share the chart. Hold on just a second. I just want to show everybody that what I'm watching. Okay. All right. I guess this is it. All right. Let me know if you guys can see the screen.
Absolutely. Looks great.
Okay, awesome. Yeah. So what I'm looking right here is a chart of the SPX, and these are the highs, obviously, and this is the high that we had in August. So the fact that we broke this high, 2193, around this area. So right now this is the first break above the high right here. Usually when you get a breakout, you expect like a little flurry to the upside, and then you literally have to retest this area for a more consolidation. So you basically need to have a solid base from where the price needs to pop again. So I think that we are so extended from this low that we had on November 4th. We are so extended to the upside, and I think that a pullback is actually about due right here, and I'm expecting a pullback into 2170, even 2180. If this continues to be a news-driven market, if into next week we should get some positive announcements, this can literally push the market higher. But let's not forget that this is probably, we're still going into that rate hike thing in December. So I think this could very well be the last hurrah for the market. So we don't know that. As a technical trader, we have to trade it one day at a time, and we have to trade patterns. It's all there is. You have to keep it super simple for traders, and not forecast and not try to guess. Okay, what is the next high? Where do we literally think that this market is going to go? It could go go to certain points, technically speaking, but at the same time, you know, you have to take into consideration, you know, what is the catalyst that is driving this market higher. And so far, this market is continuing higher today without a lot of announcements. And you know, like I think Jim mentioned earlier, there are not a lot of economic releases. You know, throughout it's a pretty slow week in economic releases. So the market, the fact that market is going on relatively low volume, higher right now, you know, it's not necessarily a good thing, but it's not a bad thing. So investors are seeing this as positive. I have a lot of trades that have triggered. I have a list of swing trades that I just took this morning. And to be very honest, I've never been in so many trades in a very long time. I'm usually in probably 7 to 10 trades. And literally, like this morning, there were over 20 trades that triggered. So very, very good for the market. So anyways, we have to trade it like one day at a time, and this is what I'm looking at right here. So the fact that we did this peekaboo high above this resistance area, it can continue higher. Like I said earlier, I think the 2200 is going to be the area where we're probably going to have a little bit of a tough time. But other than that, just trade it one day at a time, because if we don't trade it one day at a time and we think that, oh, the market doesn't have room to continue higher, then you miss all the trades. You have to trade, and I think in trading, and this is the way I was taught, is that you have to take every trade and every opportunity that sets up in your favor. Don't think and just do it. Trading is not a game about thinking. Trading is about doing. You see the pattern, you take it, you take the trade, you don't overthink it. If you start overthinking and overguessing, then you're not on the right side of the trade, because you get your emotional side all wrapped up in the trade.
Right. I agree with a lot of that. What type of coffee are you drinking over there, Anka?
I don't drink coffee at all.
You don't drink coffee? Good Lord.
I don't drink coffee at all.
Oh, wow. Okay. Well, no, I like your enthusiasm. It's awesome. Just to get kind of caught up here, I do want to just, if I could just take a minute, if you guys don't mind. S&P 500 is breaking out to new highs, obviously, especially with today's actually going on. The only concern that I have about the Ps is that these V-shaped recoveries at high levels are hard to sustain. And the reason that is because by the time the market gets all the way up to these new highs, it's already overbought as it's breaking out. Now, a market could do whatever it wants, and like Anka says, we just kind of follow along and don't think too much. And that's kind of where I am. In fact, my nickname in the industry, which wasn't flattering at the time, but now I've embraced it, is the trend following moron. So as long as the market's making new highs, I'm not going to argue with it. Mm-hmm. What's amazing is usually when you get these big picture ideas like steel and iron and base metals, et cetera, you get a pop and then they don't follow through. But I'm amazed that this market so far has followed through. So I think corrections in these base metals might be worth buying. A couple of things I want to point out real quick. I'm very encouraged that the Russell 2000 is finally breaking out to all-time highs. A little concerned about it's not doing it with as much acceleration as it has, but I guess you can't have everything, and if you did, where would you put it, right? So at least we're at new all-time highs in a Russell, and we waited for a couple of years for that to happen. So that's a good thing. Vicious sector rotation, just a couple of more things in here. It's kind of interesting. The old school stocks like the Amazons, the Facebooks, et cetera, they're rallying today. They look like they could be in trouble if you're an aggressive trader. I'm not really excited about shorting this market, but if you felt like you had to pull off a short, Amazon, Facebook, et cetera, but only on a trigger, wait for them to turn back down. Those aren't looking so great, but the brick and mortar stocks doing really well. I guess banks are doing well. If you're going to build a wall, it's going to take bricks and mortar, right? And one thing that's very encouraging, though, in spite of the vicious sector rotation, the semis have recently broken out in here. So overall, I'm feeling pretty good about this market. Overbought, a little scary to just buy in now. But as a pullback player, that's a good thing because we're going to have to wait for a pullback anyway. So we're not going to buy into new highs. We'll have to wait for a pullback. So overall, things looking pretty good. One exception, bonds are beginning to or have been imploding in here. Eventually, that could put a little pressure on stocks unless I don't want to confuse the issue with facts, but unless the economy improves significantly, that could handle these higher rates. But usually, I don't worry about the whys at all. It's just what is. So long-winded market update there, but thanks for letting me get caught up, and I appreciate that. Let's go back to you, Jim. Question of the week is, and I know what it is, but let me just read it verbatim. Always something to go wrong here, right? Okay, how do you decide what amount of your trading portfolio to put into a trade? And do you use the same amount each time, or is it different for each trade?
Well, I would think, it would vary obviously from investor to investor and trader to a trader. My opinion is to try to obviously keep powder dry on any one trade. So obviously one trade doesn't decide the life of your account. I think, this is just my opinion. With the limited risk options, obviously, if you're on the buy side with limited risk strategies, you can limit your exposure on every one. Like right now, for instance, as an example only, with the VIX trading at 12.5, we're up here at 2,200. The Russell is up, but it's certainly not running away. It's had a 15% jump in a very recent time. So there's a lot of speculation on growth right now. We have got a boatload of news next week on the economy and on consumers and stuff like that. And so if the premiums are very low, much lower, because, before the election, we had the puts going for almost twice the amount of calls, which means the world was really positioned for the down move, which means they're all getting wiped out, which means they're all covering all that stuff. And the market makers probably were going very much on the other side of those trades, meaning they were short the puts and long the calls. And obviously that was the play. So now that that's been rebalanced, right, and all that volume has been offset and all those people are now gone or in the process of being gone, is there a setup here where a strangle situation where a call and a put, limited risk, might be worth an investigation, so that if this thing takes off through 2,200, then obviously there'd be a call involved. And then if the market pulls back to fill this gap, which is between 2182 and 2186, which we just created, or goes down to test the weekly low of last week, 2150, or if it goes down and tests the 2080 low, which is this month's low, obviously there could be very much premium expansion with the VIX jumping from this 12 neighborhood up to 16 or 18. And the news next week would certainly be able to stimulate that type of activity. So if there's nobody behind us on the volume side with the buying, and this is primarily people just trying to get some exposure to stock and cover all that all that negative positioning that they had before the election, then there may not be a lot of legs after this. And there could be vulnerability up here. And a strangle position would be something to investigate because, obviously you have a call and a put going at the same time. And if the premiums are relatively low and we do either A, accelerate through here, or B, give it up, those premiums could expand and this VIX could go from the 12s up into the higher regions in the next 2 weeks. We'll have to see what happens, but I think that is something very worthy to investigate, because the 52-week low on the VIX is 11 and it's at 1250. So you don't have to be a genius to figure out that's pretty low. And then the weekly high is 32. So it's obviously nowhere near that level. So if volatility was going to pick up significantly in the weeks ahead, this is not a bad neighborhood to consider looking into something like that.
Okay. Well, sometimes what we do is we have a bonus question, which is a trade of the week. So it sounds like you just answered the bonus question. Did you? I didn't catch the full answer on what percentage do you?
Like I say, I don't have an etched in concrete. If something looks very, very strong to me, obviously I risk a little bit more. If some, so in other words, to give you an exact answer, risk 10% of your account on any one trade, or 7% of your trade account on any one trade. These are typical numbers that I've heard over the years. Obviously, that 8%, 7% stop loss type thing. So, there's some numbers like that. I think it's a very personal thing based on your wealth and your suitability and all the rest of it. So, I don't think you can hand out, concrete answers to variable answers.
Okay. Barry, how do you decide what amount of your trading portfolio to put into a trade? And do you use the same amount each time, or is it different on each trade?
It'll vary. If I certainly agree with everybody that probably you shouldn't risk more than 3 to 5% of your account size on any trade. We like to kind of, if we really like something, we like to put on multiple positions and then take off some with partial profits and then move stops up to break even as soon as possible. Then you have a free trade. So, we think we bought the S&P last week around 2181. And, we've been taking profits at 86 and 88 and 92. And, but we've moved our stops up tightly now to 2184. But I agree with everybody that, it depends on your account size. I mean, we also manage an ETF timer portfolio, which has an ideal account size of like $100,000, which is if you're in if you have a retirement account or something like that. And even on that, we like to only put on at maximum $10,000 on, or 10% on any one trade, and sometimes we'll recommend a half position of on that. And then again, like anything, we like to take partial profits because you let your profits run and you move your stops up as quickly as you can, especially in a trending situation, so that you can let it run.
Okay, Anka, same question to you. How do you decide what amount of your trading portfolio to put into a trade, and do you use the same amount each time, or is it different for each trade?
I use the same amount every single time, and I usually risk 1% per trade, and not usually. I risk 1% per trade, and this is my risk amount. And especially, I have adapted it for this year because it was a very choppy year for swing trading. It was rather a core year, and because I was taking core positions more than swing trade positions, so I had to adapt. And then my risk was 1%. I usually risk on a day-to-day basis on a trending year 2%, and that is a fixed amount, not less, not more. And this is because of the risk to reward ratio, and it overall gives you a great winning percentage at the end of the quarter and at the end of the year. And I do suggest, like, if there are any new traders that are listening in, I would even go as low as 0.5% per trade, because that what that happens. So the whole mechanism here is that if you risk, let's say 1%, and that is, let's say, $1,000. So if you risk $1,000 on a trade and you lose, if you risk another $1,000 on another trade, if you lose, if you risk another on your third trade $1,000 and if you lose, and then you decide and say, oh, you know what, on my fourth trade, I'm only going to risk half of that amount, and you risk $500. That is the exact trade that is going to offer you the opportunity to run and hit your targets. And the downfall for that is that you've used half of your position size and you're not able to recover the first 3 losses that you had, versus if you would have taken the trade with the same risk amount, it's easy math, then you would recoup everything that you've had.
Absolutely.
The reason for my and one of the other reasons for my 1% for this year, and especially for the summer period that actually prolonged into the fall, was the fact that the market was very, very sideways. And I was putting on swing trades, and usually in swing trades, I'm never in more than from 2 days to about 10 days. And I was in these swing trades, like I still have KMI that is open, is running, MU that is like literally, just chugging along. But all in all, the strategy did perfect. I have very, very, very small stop outs, and this 1% or 1% for this year worked for me. And I'm going to look, if we're going to develop a very strong trend, like if the market pops higher and then it pulls back into a shelf of support that can sustain another leg higher and can sustain another consistent uptrend, then I'm going to look to up it to my 2%, usual 2%. So for the last 3 years, I've used 2% of my account, but never less, never more than the fixed amount.
Okay, I fully agree with a lot of what you said. So let me just reiterate as it relates to what I'm doing. This is the actual open portfolio. And if you want to follow along on a delayed basis, you can do that on my website. If you go down to getting started, it's like number 3 in the list of things, and it's completely free. And then the live trades down here are blocked out, but you can follow along every day for free so you can see what's happening. But using an account size of 100K to keep the math easy, we consistently risk 2% per trade. And like Anka said, the problem is if you say, okay, well, I'm going to risk 1%, you lose, 1%, you lose, 1%, you lose. And then you're like, well, I'm not going to risk too much on the next trade. Maybe I'll go 0.5%. And of course, that's going to be your big winner. And then let's say you go back to risking the big amount because you got a winner. Then, of course, you're going to lose again. So that's a big problem I see, is a lack of inconsistency with people. So we keep it at 2%. And if you're wondering why 2%, I think 2% is enough to hurt, okay? But it's also enough in case something actually takes off. So you can see in the open portfolio, we have roughly 1% profit on the first loaf, the first half of the trade. We're putting on all these shares at once, and obviously the numbers would be a little bit more round numbers, but to keep the math simple so everybody understands, I just divided out by the account size. So we're actually risking 2 on 100,000, which is 2,000 per trade, and then this gives us a share size down here. So we put on all the shares at once, but we divide them into 2 for tracking purposes. So everything that's not highlighted is the swing trade that we got out of it, and everything that's highlighted is what we're still long. So we start as a swing trader and hopefully hang around for a long, long time. And as you can see on this one, it's now up over 100%. And it's not a huge gain on the count just yet, but so far so good. It's a decent amount. It's up about 3% on the overall count, 4% total if you count the swing trade. So as Anka said, and I fully agree with her, keep it consistent. If you're new to trading, trade at a size that's so small it's almost inconsequential. So you're not going to have any psychological problems. And then slowly and gradually bump it up. It amazes me, people who aren't successful at 0.5% think they're going to be more successful if they trade 4% of the account. And they're just going to end up in a vicious spiral. And if you're not successful, just keep reducing that amount per trade until you become successful, and then slowly and gradually bump it up until you get to 2% as a maximum per trade. So that's my quick money management in a nutshell. And keep in mind that the share size is going to vary by the stops. Most of the stops in here you can see are fairly close, but sometimes you might see a 2-point stop, and they might see it. You might have a 10-point stop. So we're trading more volatile stocks in general, and the more volatile stock will have a bigger stop point value. But what we do is we compensate by trading fewer shares. So there's not a huge amount of share difference in here, as you can see. But sometimes you might see like 200 shares down here and maybe 1,000 shares up here. And again, so we're adjusting to the volatility of the market. So that's a long-winded answer of saying 2% and keep it consistent, and a lot less if you aren't successful just yet. And if you aren't consistent too, if you're just kind of swinging at everything, then don't risk a whole lot of money, especially because that means you're just trading for action. Okay. We ask about a trade of the week. I'm assuming, David, you want to do that again?
Yes, please.
Okay. All right, Jim, you gave us a trade of the week, and it sounds like you're favoring a straddle on the S&P 500. So we'll skip down to Barry. Barry,
actually, it was a strangle position, not a straddle.
I'm sorry, a strangle position. Okay.
Yeah, they cost a little less because they're a little out of the money on the call, a little out of the money on the put, and then basically you're saying that the market won't stay around this 2,200 area forever, and when it busts out of there, those premiums will expand, and that VIX will go from 12 upward. And that's basically the concept. Yeah.
Okay. Do you have a delta on that you'd like to throw out, or
no, not exactly. And like I say, it's not an exact science. Each trader could look at different strike prices, different expirations, and make his own opinion up. But the idea is when you're at 11 or 12 or so on the VIX, and when you're at an extended level on the prices, and you know the puts have shrunk down dramatically. You know, puts are down 50% since the election. That's a pretty big shrinkage in what, 10 days? So obviously that gives you an indication that the probabilities and the relationship between the market and the premiums have changed dramatically, and markets don't go in one direction forever. So that would be why investigating that concept would be very interesting right now.
Okay, that sounds interesting. Barry, let's go to you. Do you have a trade of the week?
Well, we focus more on futures. I mean, the week of Thanksgiving, I feel like is like a throwaway week, and so I don't, actually try to kind of encourage people to cut down on trading. I mean, for people who are day trading, you can trade small ranges. I mean, if anything, if the S&P gets up toward 2,200, if you want to risk maybe just even 10 points on it, looking to hold it into Wednesday or so of next week to see if we get a 30 or 40 point pullback. That's what we're looking for. But that may even set up as late as Friday, because you get this kind of grinding congestion, and it starts falling apart, and then it goes back up and retests, and so it's kind of it's a crummy week for trading futures. we're also kind of a little bit concerned. We're kind of at a place where we're getting very overdone on everything. I mean, we were short gold, after the election, and we made a bundle. We were in GLL in the ETF timer, and we took profits there. We're kind of at a place where we're just kind of really kind of overdone, and we feel like we need some rebalancing to happen. In a lot of markets, we were short the euro, we've been long the dollar, and all those markets are just way overextended. A lot of our numbers came in last week. We were looking for 150 to 170 on the dollar index. We were looking for 1215 on gold. And we're just kind of way overdone on everything to kind of initiate any new trades. And so without some rebalancing, the only thing I see setting up is a counter trend trade on the S&P as we get up towards 2200, maybe risking about 10 points on the minis, and taking partial profits. But I think more of the action on that's going to happen next week.
Okay. Anka, same question. You have a trade of the week to submit?
Yes, I do. I have Twilio for a swing trade. So this is the swing trade. I'm not doing options. Twilio is very interesting. I'm going to share my chart real quick right now. Okay, everybody see the chart? This is what I'm looking at. I called it in my swing trading service today as a long over $37.80. I think this is a very good bull sandwich at a support level of $35 here, above $35, and it has the potential to run, and we have targets all the way through $47 and $50 in Twilio. And one little recap, last time when I was on the show, I guess it was a few weeks ago, it was actually David, and if I'm not mistaken, I was on the show. Was it like, I think it was October 25th or 26th or something like that. I gave the trade idea. I gave Johnson & Johnson with a very tight stop here. The entry was 114 and my stop was 113. And it reached all our targets. So it had a beautiful follow through to the upside. So in our program, and actually I do run a managed accounts program as well, we're up over 50%. So I mean, this speaks a lot. So we have had a lot of winning trades in a very, very tough year, in a very, very tough environment. So Twilio is definitely my swing trade, and right now it's looking so really, really well. Once again, $37.80 is the entry. Gonna look for half the stop below $35, and all the stop will go below 34 for the last half of the position, 34.65. So this is the bull sandwich right here that is trying to climb higher. Okay. And this is going to be a medium-term trade. So it's going to be a medium-term trade. It's not, so probably will develop throughout the next couple of weeks.
Okay. Go ahead.
Was that October 24th that you were on last?
October 24th. Okay. Awesome.
She recommended the two Johnsons. Cool. I actually do have a trade. This was just recently triggered. Earlier, remember, I had this blacked out down here. I was leaving it blacked out because it was right around the entry price. But this is a trade, and it's still an open trade. It's still a valid trade. We just triggered into this one, so it's kind of ironic, don't you think? But anyway, remember earlier I said the share size would vary. Notice that the share size is much larger here. Remember, you would double the share size up here. So this would be, let's just say 400 shares, round numbers, and now we're looking at 1,300 shares because the risk here is 1.5 points, and the risk here was 4.5 points. But here's the setup. It's veil. The action is to buy. This is per 100K based on the money management of 2% that we just talked about. Entry 770, which we're right around there now. I would use today's high, whatever that is. We'll take a look at the chart one second. It's a new entry, but it's like right 20. Your initial profit would be 920. Once you get to 920 or somewhere in between as you trail your stop, you would come up to break even. But by the time you get to 920, if you do get there, you bring your stop to break even and take off half of the shares. That's how the money management works. It's out there in the money management and plenty of information on the website if you're interested. Let me get to the actual chart real quick, and I promise I'll go quickly and just show you the entry and what I'm thinking about. This is a steel stock, and this is a foreign steel stock. The American steel stocks are doing incredibly well, especially because Trump's not going to use any more steel from China But this is a foreign stock, and I just think it's kind of interesting that it's setting up in spite of the fact that it's a foreign company. But anyway, your entry is like right around the high of today, let's say 771. So give it a little bit of wiggle room above that for a new trade. And then the rest of the parameters, you can rewind the tape for those. This is a pullback. I'm a pullback player in general, looking for a reversion to the mean, move back in the direction of the trend. And once we get above 9 and change, we'll be taking partial profits, or hopefully we get there. And I hate to use the word hope, but anything is uncertain in this business, as you guys and ladies know, or lady knows. Anyway, so that's the trade of the week. It looks like it's starting to re-trigger right around now. Let's go to Jim Kinney. Let's go back to you, Jim. Do you have any closing thoughts or anything, floors to you, anything you want to tell us about optionprofessor.com or your trading or the markets, whatever you want?
You bet. I do have some ideas here. Again, they're only my opinions, so keep them in line. But the three basic areas that people do take a look at in there is stocks, bonds, and commodities. I just want to give a brief statement on each. On the stock market, the good news is obviously the prices, and that's always the best news to follow, right? So that's good news. And the transports, they're up about 37% since January. So they've had a very nice long run, but they haven't taken out the highs of 2014 yet. They may do that. The other thing that's very good for stocks is wages are up and the consumer spending seems to be pretty good. And maybe this tax cut will give the consumers more money. And, 2/3 of economic growth is the consumer. That's all good stuff for stocks. The not so good stuff is the Russell spiking up so quickly, which means people are speculating on growth, up 15% since the low just last month, I guess. And then, of course, we have to make a little figuring out because everyone is so negative in the election. There's been a tremendous lot of short covering and that type of thing. And short covering alone cannot keep the market going. This Goldman Sachs Financial Conditions Index has not really been matching up with the rally. And I just said the VIX is down at 12. So I'd be a little careful up in this region on how things will progress from here.
I never try to confuse the issue with facts, but I always pick up a couple little tidbits on this show, and I always learn a lot too. But that's an interesting point that everyone was so negative coming into the election that you're going to have to unwind some shorts. So that might be some of what we're seeing now. And I guess if it's sustainable, it's sustainable. That's what a trend follower does, just follows along. Yeah. But that's an interesting point that I didn't even think about. So that's cool.
And then, you wouldn't fight the tape. So what numbers would be lines in the sand? And of course, this gap around 2180 would be a line in the sand. Last week's low, 2150, a line in the sand. And of course, this month's low of 2080 would be a line in the sand. So as long as those lines in the sands are not being violated, obviously you don't want to be the man who cried wolf. So on the stock market, and that's the main thing I see there. On the bond market, that's really the big story. Now people are talking a lot about it, but you've seen yields on the 10-year go up to 2.25 or better. You've seen the 30-year get above 3. And you've got a lot of people who bought a lot of bonds who used to buy CDs and used to buy money market. And I don't know how much heat they can take. We're going to find that out because these leverage funds, these closed-end leverage funds, they're not easy to get out of. And if you get a redemption run sometime in the first quarter or at the end of this year because their bond portfolios are not doing well and they're not used to that kind of downdraft because everyone who bought a bond made money until last month, right?
Right.
That's a big sea change, if it is a sea change. And so don't discount that because that also changes your valuation models on stocks when the 10-year is at a much higher yield than it was. And that's going to be some kind of a factor. So keep an eye on the bond market because it does look like the winds of change have blown very, very deeply on that. Certainly it's oversold now. So don't be surprised if you got a reaction the other way. But again, if the main sea change has happened, that's an important thing right now.
Yeah,
and then the last thing.
Go ahead.
No, you go.
No, I was going to say that's an interesting point once again, because in a case like that, I didn't think about it in that light, but return of capital becomes a lot more important than return on capital, and that's a total different mindset, and that's a total different. Like you said, could be a little bit more. That's a little bit more panicky. People were used to a certain return. then they get worried about the return of the capital versus return on the capital.
Anyway, that Julian Robertson, who's a pretty famous hedge fund guy, a very older guy now, but he was saying that the Fed's policies have turned extremely safe investors into speculators. Anybody who's bought a bond knows that the liquidity on some of the bonds are not exactly top shelf. And if people want to get out en masse in any market and create an order imbalance, it can be a messy environment. That's just something that I think is more on the chart now than it ever was because of the activity we've seen in the last month.
Cool.
So I just wanted to finish up with the commodity sector. Oil is very interesting now because if it starts getting above 52, it could surprise people with a bit of an acceleration to the upside. A lot of people are very sanguine that oil will not move and it'll stay in this range forever. If we start breaking above 52, they may have to change the opinion there. Two other commodities that people might be looking at is the soybeans, which are trying to take out last month's highs, and of course South America crop starts coming in, and it'll be interesting to see if that'll have legs. And then finally the metals, obviously they let all the air out of the balloon there as far as the bulls are concerned. Those call options have shrunk way down. Now they're in the more of the, are they going to hold their lows? If they hold their lows and start reversing up, then obviously they could get back on the bicycle. But that strong dollar has definitely not been a friend to the metals. And if the dollar is peaking here a little bit at 105, then maybe these metals have a better future. If the dollar index is going to 120, then I think these metals may have a more difficult environment looking forward. So those are just some of the opinions.
Yeah, another great point, that intermarket analysis, it doesn't always work, but when it works, it really does work well. And then that's one relationship I've seen that's a little bit more predictable or more correlated than others, is that dollar commodities. We're running a little late, so let's hop over to Barry. Any closing thoughts on anything, Barry? Anything you want to talk about, or anything you want to talk about with Forecast.com?
Well, we cover futures and ETFs, and a lot of our concern is that a lot of key numbers have come in for us that we've been looking for, and that things are just way overdone, and so we have to wait for rebalancing. I mean, our long-term perspective is that stocks will go up next year. We'll certainly see 2,300 or 23, maybe even 2,400 on the S&P. But the underlying economic data, is starting to kind of. I know Martin Armstrong recently gave a sell signal that his long-term economic data is fading, which means that the stock market will top out 6 months later. So we're going to have to pay attention to that. At Forecast, we have a lot of traders who are kind of interested in swing trading 1, 2, 3 days, day traders and things like that. We cover 13 commodities. You can get trials of our service at www.commoditytimers.com or Forecast.com. I think we put up a free offer. You can get a free trial. You follow the link that Dave is going to put up after the show. We're very again, we look a lot at social economic data and cycles and things like that, and we're very concerned about the month of December. I think there's going to be a lot more fear coming out of the market. I think I think there's the unrest after the election is going to continue for a couple of months, going into the March on Washington and the Trump inauguration, and I think that environment is going to create is not going to allow the markets to kind of continue galloping like we've seen the last couple of weeks, and so there's going to be a lot of rebalancing happening. We had been looking for the dollar to go up to 101.50 to 101.70. It hit that target, and it needs. We had cycle lows in the month of December, so I think things are just way overdone, and we probably have to wait for better setups in January. And we have our long-term monthly report coming out, which will cover the 6 months of next year. The Forecast Financial Visions Report, the new one will be coming out next week, and so you can look for that. So take a look at our offers, and we'd love to work with you. We've #2 timer last year in the S&P. I was just told by Timer Digest that we're going to be in the top 5 for gold again in the latest issue coming out. So we're low key, but we're very good.
All right, well, nicely done. Anka, any closing thoughts to you?
I think we should take trading one day at a time and see what the market and what are stocks, because I'm a stock trader, ETF trader, and also a futures trader as well. So I think we got to take it one day at a time to see what is being offered. And also, I think that is very important to pick some relative strength stock and start riding them into the year end, because this is going to be key. And let's not forget that in December we're going to have the end of the quarter. Not only that, but we're going to have the end of the year, and we're going to have that big event calling window dressing. So I think that picking winners and picking high flying stocks is going to be the key moving into December's trading, and this will be regardless on what the market is doing. I don't see a very big pullback in the market, and I don't see a collapse in the market. So from now on, I just see the market trending. It's obviously due for a pullback, so don't panic on the pullback. If you like to sit through the pullback, or if you like to trade the pullback, my advice would be, and this is what I'm going to be doing, I'm going to look for some relative weak stocks to short within that short period of time for that retracement. Also, for those of you listening, I post every morning on YouTube, on my YouTube channel, which is youtube.com/tradeoutloud. That my pre-market game plan for the major future indices, gold and oil, that I trade on a day-to-day basis. And today I had a killer trade in NQ with the entry with the entry at 48.20. So it was a phenomenal trade moving to the upside. Those are free for everyone. And also I post on Mondays afternoon, I post my weekly swing trading report and I go over at least 10 to 15 stocks on a regular basis. And this is also for free. And I give entries, targets, my market analysis, my buys, etc. And that is also on youtube.com/tradeoutloud. We also will provide a trading signal, a signal service for futures, for day trading and swing trading. That is starting on January 9th, which is very interesting. And this comes also by popular request. And we are also running a very successful swing trading newsletter, which, like I said, the batting average is about 87% on the trades with trades, with transparent trades and portfolio display since 2011, since we have started this program. So since then we have been positive. We have been in winning trades, and we have amazing results. So if you wanna check out our portfolio for this year, more than happy to email that for you, or you can visit from 2011 to 2016. Our portfolio is free for everyone to view online.
Okay, cool. Okay, we're running a little late today, so I'll try to keep it snappy. If you go to my website, like Anka, I also do a little market update. This is kind of it's a serious market update, but it's also a little bit of fun too. So it's only a minute if you get a chance to watch that. And like I said, I got tons of content on my website. There's over 500 more posts. I think I need to put a 6 in front of this now. Earlier, I mentioned my free delayed trading service. You can get started right here. And the bottom line is, get to know me first. Don't spend any money, but come in here and take a look at the website. Come to each of the weekly webcasts that we have here. It's on the homepage. We're going to take a break on Thursday due to Thanksgiving, but obviously we'll start up the following Thursday. You can come to the show, ask any question that you want about trading. Also, if you go to DaveLandry.com, you go to DaveLandry.com, you go to contact to get in touch with me, or you can just email me directly at Dave@DaveLandry.com. I answer my own emails. And then as far as the YouTube channel, you can find that on my website under Getting Started if you need a direct link, or like Anka, I also have a channel, and it's www.youtube.com/Landry.com, and the dot is spelled out. So it's Dave Landry, DOT.com. And that's, again, my YouTube channel. So check that out. I've got 1,700 videos there, so plenty of information to keep you busy. Come to the free shows for a while, check things out, and then I think you'll be impressed. Everybody, I'm going to let David wrap things up, but this was a great show. I really enjoyed you guys. Thanks for jumping in last minute there, Jim. Appreciate that. I'm sure Cosmin appreciates it even more. And I think with all the technical difficulties, I didn't thank David Cosmin and Timing Research. So I want to thank both you guys, or the website and you, David, for having me on today. And show's back to you, David.
Yeah, you're welcome. Always great having you on. And let's see. Just want to remind everyone watching that you to subscribe to the Timing Research YouTube channel as well to get future updates on the show or updates on future shows. You can also go to TimingResearch.com and download any of the past reports or watch any of the past shows there. Be sure to join us next week. Scott Macbeth of BestChoiceSoftware.com is going to be on for the first time. Also, Larry Gaines, Neil Batho, and Matt Buckley will be back as moderator. I just want to thank my guests again for this week. Barry Rosen of FortuneCast.com, Anka Metcalf of TradeOutLoud.com, Jim Kenny of OptionProfessor.com, and Dave Landry of DaveLandry.com. So
Thank you.
Thanks, everyone.